Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here.
So I want to start by asking you just take a quick look at your calendar. It's Monday, January 26th, 2026. And if you've been watching the news or, even just glancing at your retirement account lately, you might be feeling a little bit, let's call it motion sick.
Motion sick is a polite way of putting it. I think whiplash might be the more accurate term for what the markets are doing.
Seriously. Because for decades, my entire adult life, there has been this one golden rule in finance. It's almost like a law of physics. When the world gets scary, when tensions rise, what do?
You buy U.S. dollars. You buy U.S. Treasuries.
You run to the safety of Uncle Sam every single time.
Exactly. It's the flight to quality. It has been the playbook for 50 years. The house is on fire. You run to the fire station. And, well, the U.S. Treasury market has always been that fire station.
But, and this is where things get really interesting and maybe a little nerve-wracking, if you look at the data from this past week, that rule seems to be breaking.
It is breaking. We're seeing a phenomenon that some analysts are calling sell America.
Sell America.
Wow.
That sounds incredibly ominous, kind of like a going out of business sale.
It's significant. We're seeing investors who are now demanding a premium, so they want extra return, just to hold U.S. assets because of these policy risks. The safe haven isn't looking so safe all of a sudden.
Okay, so let's unpack all of this, because for today's deep dive, that's our mission. We're going to look at why that U.S. safety status is wobbling, something the research calls the triple weakness.
And we're going to follow the money. Because if it's leaving the U.S., it has to go somewhere.
Right. And spoiler alert, it is heading east.
Yeah.
We're also going to talk about how huge players, like Blackstone, are stepping into a really unique situation in Japan.
And finally, the hidden bottleneck in the AI revolution. It's not what you think.
It's not chips, it's electricity. There's a fascinating web of connections.
It really is.
So let's start with this sell America thing. Usually in Economics 101, they teach us if stocks go down because people are scared, bonds go up because people are buying safety. It's a seesaw, right?
Correct. That's the traditional correlation. It's what balances your portfolio.
But that is not what we saw around January 20th.
No, not at all. According to recent market analysis, we saw a triple weakness. The U.S. dollar, U.S. Treasury bonds, and U.S. stocks were all falling.
All at the same time.
Simultaneously.
That just feels wrong. That's like gravity stopping for a day.
It's very rare. And it usually points to something systemic, not just a normal market fluctuation. And the catalyst here seems to be what reports are calling policy weaponization.
Weaponization. That sounds intense. What exactly triggered it?
Well, looking at the data around the 20th, the market reacted pretty violently to the threat of new tariffs on Europe. Specifically, this is tied to the ongoing dispute over Greenland.
The Greenland issue. I saw the headlines. The Trump administration is really pushing hard on that one.
They are. And the administration put some very concrete numbers on the table. A 10% tariff starting February 1st, and that goes up to 25% by June 1st if a deal isn't reached.
Okay, but let me play devil's advocate for a second.
Okay.
We've had tariffs before. We've had trade wars. Why did the market freak out so much this time?
That's the key question. It's because tariffs are usually used for, trade disputes. You're dumping cheap steel, so we're going to tax it. It's an economic tool for an economic problem.
Right.
But here, tariffs are being used as leverage for a geopolitical goal, territorial rights, resource access.
So it's not about economics, it's about pure politics.
Exactly. And for an investor, that is terrifying. Imagine you're playing a board game like Monopoly. You know the rules, you have your strategy. Then all of a sudden, the person across from you decides to change how the dice work because they want to take your boardwalk property.
I would flip the board over.
Of course you would. It introduces governance risk. You can't put that in a spreadsheet model. If the rules of the game can just change overnight for political reasons, investors are going to demand a much higher return to play.
That makes perfect sense. It's the unpredictability. And on top of that, wasn't there something about the Federal Reserve feeling the heat too?
Yes. And this is the second leg of that triple weakness. There have been reports of increased political pressure on the Fed, even summoning members to Congress.
And the Fed is supposed to be independent. They're the referees. They aren't supposed to care what the president or Congress wants.
Precisely. The minute the market starts to believe the referee is being influenced by one of the teams, the whole game loses its integrity. Investors have relied for so long on the Fed put.
The idea that the Fed will always step in and save the day.
Right. But if the Fed's independence is in question, that safety net looks like it's full of holes. And that is why you sell the dollar and the bonds.
Okay, so I'm a big global investor. I'm looking at the U.S. and I'm thinking, too much drama, too much risk. I'm pulling my money out. But where does it go? You can't just stuff it under a mattress.
Well, money never really sleeps, does it? It just migrates. And right now, the data shows a very clear migration to Asia.
Okay, let's see the numbers.
If we look at the exchange-traded fund data for the week ending January 16th, the trend is just stark. Asia-Pacific ETFs saw inflows of nearly $1.1 billion
Wow, $1.1 billion.
in 1 week.
And in that same week, the Americas, they saw only about $0.6 billion.
Yeah.
The capital is flowing east.
Why Asia? Is it just because it's the not America trade?
Well, that's part of it. U.S. stocks feel pretty expensive right now. But Asia and Japan in particular looks cheaper in comparison. Plus, and this is a big deal, corporate Japan is in the middle of these massive reforms.
Yeah. For the longest time, Japanese companies were famous for just sitting on mountains of cash. Now they're finally starting to treat shareholders better, buying back stock, raising dividends. It's a classic value play. It's like finding a designer suit at a thrift store.
A better deal.
Yeah.
But you also mentioned people aren't just changing geography, they're changing what they buy, from paper assets to real assets.
This is the other side of that safety coin. If you can't trust a U.S. government bond, which is really just a promise on a piece of paper, you start looking for things you can, actually touch.
And is that why we saw gold and silver moving?
Absolutely. In that same volatile period, around January 20th, gold shot up 3% and silver jumped 4%. For defensive assets, that's a huge move.
It's basically investors saying, I want something that has value, no matter what a politician says or tweets.
Precisely. It's a shift toward real assets. So things like real estate, infrastructure, gold. I like to call it the zombie apocalypse test. If the whole financial system freezes, a bond certificate is just paper. But a building, a gold bar, a power plant that still has real, tangible value.
Which brings us perfectly to Japan. Because if all this money is flowing there and people want real assets, that must be creating a massive opportunity.
It is, but it's a complicated picture. I mean, Japan has its own issues, but it's also become the key battlefield for capital right now. And they just had their own major shock in January.
The JGB shock, right? Japanese government bond.
Yes. The 10-year JGB yield hit 2.38%.
Now, for our listeners, 2.38% might not sound like a lot. My savings account pays more than that. But for Japan...
For Japan, it's seismic. It's a 27-year high. You have to remember, for basically 3 decades, their interest rates have been stuck near zero.
So why is that such a shock to the system?
Okay, imagine you're a Japanese bank. For 20 years, you've been buying these super safe government bonds that pay almost nothing, say 0.1%. Suddenly, new bonds are being issued at 2.38%.
Nobody wants your old bond anymore.
No one. The value of those old bonds you're holding justly, it collapses. So all the banks are suddenly sitting on these enormous paper losses.
Oh, they get scared.
It's like a sudden freeze. They look at their balance sheets, they see all this red, and they just stop lending. They clam up.
But wait a second. You just said Japanese companies are reforming and growing. There's a huge merger boom happening there. If the banks stop lending, how on earth does these companies get the money they need?
And that is the trillion-dollar question. The answer is private credit.
Private credit. We hear this term all the time. Can you break it down for us simply? Is it like a loan shark for big corporations?
No, not quite a loan shark. Think of it more like a private bank for big business. Instead of a company going to a traditional, highly regulated bank, they go to a massive investment firm like Blackstone.
Okay.
These firms have raised these huge pools of money from investors, and they lend it out directly to companies.
So when the traditional banks freeze up from the bond shock, Blackstone just steps in and says, we're open for business.
Exactly. And they can be much more flexible. It's a hybrid solution. It's faster. It's more creative. And right now, it's filling this critical void in the Japanese economy.
It really sounds like they're capitalizing on the chaos.
Or you could say they're providing stability in the chaos. And they're not just targeting companies. They're looking at the Japanese people themselves.
This is the part of the research that just blew my mind. The Japanese piggy bank.
It's a staggering number. Japanese households are sitting on roughly $15 trillion in assets.
15 trillion with a T. It's just an unimaginable amount of money.
And historically, more than half of that has just been sitting in cash or in bank deposits earning, 0% interest. It's a cultural hangover from decades of deflation.
When prices are falling, cash is king.
But now with inflation coming back and rates rising, that cash is starting to wake up. And this is where Blackstone sees the big opportunity. They call it the gap.
Tell us about the 3% versus 30% gap.
So big institutional investors like pension funds or university endowments, they typically have about 30% of their portfolios in these private markets like private credit or real estate. They do it for the higher
Okay,
returns.
so the pros are at 30%.
But individual investors, they usually have only about 3% in these kinds of assets. So Blackstone looks at that and sees a 27-point gap to fill. They want to convince Japanese households to move that money from a 0% bank account into their funds.
And the Japanese government is actually helping them with this.
They are. There's a big policy push called Asset Management Nation and reforms to their tax-free savings accounts called NISA. It's all designed to get people to move from just saving to actually investing.
But why would a regular Japanese person who is famously risk-averse put their money into something like private credit?
One word: yield, the paycheck. As of January 2026, Blackstone's big private credit fund, BCRD, was offering an annualized distribution of roughly 9.7%.
Whoa, 9.7%.
Now, compare that to the 0.01% they were getting at the bank for 20 years. I mean, even after you account for the costs of hedging the currency, it's incredibly attractive. It's what they call the retailization of private markets.
Bringing Wall Street to Main Street Tokyo,
That's it.
that is just a massive, massive shift. So, okay, we've got money leaving the U.S. heading to Japan. We've got private credit replacing banks. But there's one more piece to this puzzle, and it involves the biggest buzzword of the decade, AI.
Artificial intelligence.
And normally when we talk about AI, we talk about chips,
Mm-hmm.
NVIDIA, GPUs, all the software. But this deep dive suggests that might be the wrong place to look now.
It's not the wrong place, but it's a very crowded place. Everyone owns the chips now. The real deep dive angle here is the physical bottleneck. AI isn't just code floating in the cloud, it has to live somewhere.
In data centers, massive buildings filled with servers.
And those servers need juice, an enormous amount of electricity. And that's where the problem is, especially in Japan.
What's the situation on the ground?
Japan's power demand is projected to just skyrocket by 2030. And data centers alone could end up consuming up to 5% of the entire country's power.
Can the grid even handle that?
Right now, no. There's a gridlock. In Tokyo, there is a literal wait list to connect new projects to the power grid.
A wait list for electricity. That sounds insane.
It is the reality. You can build a billion-dollar data center, fill it with the fastest chips in the world, but if you can't plug it in, it's just a very expensive warehouse.
That's a disaster for a tech company.
But it's a golden opportunity for an infrastructure investor.
Ah, I see where this is going now.
This isn't a tech story anymore, it's a real estate and infrastructure story. Firms like Blackstone are realizing that owning the power generation and the access to the grid is now just as valuable as owning the chips themselves.
So power access is the new premium asset. It's like the old saying about a gold rush. Don't dig for gold, sell the shovels.
Mm-hmm.
Except here, you're selling the electricity to run the shovel factory.
That is a perfect analogy. If you own the land that has the power connection, you hold the keys to the AI kingdom. It all ties back to that real assets theme. In a world of digital AI and volatile paper money, the most valuable things are physical. The copper wire, the power plant, the land.
That is such a fascinating pivot.
It's creating a whole new definition of value.
Okay, let's try to connect all these dots for everyone listening, because it's January 2026, and the entire financial landscape seems to be shifting under our feet.
Let's tie it all together.
First, political risk in the U.S., those tariff threats, the pressure on the Fed, it's creating a triple weakness. Stocks, bonds, and the dollar are all falling together.
Which is kicking off the sell America trend.
Second, that money is flowing east. It's going to Asia, particularly Japan, and it's looking for real assets like gold and infrastructure.
Seeking value and physical safety.
Third, in Japan, a sudden spike in interest rates basically broke the traditional bank's ability to lend. And that opened this huge door for private credit firms to step in and become the new bankers on the block.
And they're funding this by tapping into that massive $15 trillion piggy bank of Japanese household savings, luring them in with high yields.
And finally, the AI boom is colliding with physical reality. It's created this desperate need for electricity, which is making power grids and the infrastructure around them the hottest real estate on the planet.
It is a complete restructuring of how capital flows around the world.
It really challenges our entire notion of what safety even means.
It does, and that brings me to a final, maybe provocative thought I'd like to leave with our listeners.
Go for it.
We all grew up being taught that safe means a U.S. government bond. That's the bedrock of finance. But look at the world in 2026. The bonds are falling. The dollar is falling.
Right.
So maybe true safety isn't found in a government's promise anymore. Maybe in this new era, true safety is found in owning the physical backbone of the actual economy,
Yeah.
owning the rental housing that people live in, owning the power grid that runs AI, owning the private loans that keep companies afloat.
So the very definition of safe is being rewritten, from government paper to essential infrastructure.
Exactly. And the investors who understand that shift are going to be the ones who navigate this new world successfully.
That is a lot to think about. I think the next time I look at a power line, I would see it a little differently, not just a wire, but a gold mine.
As you should. Thank you so much for breaking this all down with us today. This was a wild ride.
My pleasure.
And thank you for listening to Investment Insight. We hope this deep dive gave you a clearer map of where the money is moving in this crazy year. Don't forget to subscribe and hit that like button. We'll see you next time.